Hey, you are listening to What the Sigma with Chad Stacks. Today on the show, Wall Street's biggest players are pulling billions out of the most aggressive corporate Bitcoin play in history, and things are about to get wild. Look, when the most important corporate Bitcoin bet ever made starts hemorrhaging $5 billion in 90 days, you don't get polite disagreement. You get a collision. And I'm not being poetic. I mean $5.38 billion of institutional money just walked out the door. Strategy. Yeah, formerly MicroStrategy, because apparently everyone's rebranding now. Just watch BlackRock, Vanguard, and Capital International head for the exits in Q3. These aren't crypto skeptics. These are the institutions that own everything. JPMorgan alone pulled $500 million. The stock's down 43% in a month, 57% over the past year, trading at 170, while analysts are still publishing price targets of 524. Which means either Wall Street analysts found some fantastic substances or something very strange is happening beneath the surface of this trade. And here's where it gets interesting. The story you're hearing, depending on which corner of the internet you inhabit, is either Michael Saylor's Bitcoin gamble is finally imploding, or JPMorgan is executing a coordinated hit job on the future of money. Both narratives can't be true. Or can they? Let me walk you through what's happening here, because this isn't just about one stock. This is about what occurs when you try to bridge two completely incompatible systems, legacy finance and crypto, using a corporate treasury as the connector cable. Spoiler alert, the cable might be on fire. Start with the basics. Strategy holds 649,870 Bitcoin. That's roughly $56 billion worth at current prices. They bought it at an average cost of $74,430 per coin. Bitcoin's trading around 86,000 now, so on paper, Saylor's winning. The Bitcoin bet is up roughly 16%. Over 5 years, Strategy stock rose over 500% compared to Apple's 130 and Microsoft's 120. Over 2 years, it's up 226%. So why is everyone running for the exits? The first crack comes from something called MNAV, multiple to net asset value. It's asking, how much premium are you willing to pay above the value of Strategy's Bitcoin holdings? At the peak, investors were paying 2.5 times. That means if Strategy held $100 worth of Bitcoin, the market said the company was worth $250. Why? Because Saylor figured out how to use equity markets and convertible debt to accumulate Bitcoin faster than anyone else. That operational leverage, that financial engineering, was worth something. But that multiple just compressed to 1.16. Jim Chanos, the legendary short seller, called it. He said he expected the metric to decline and eventually hit 1.0. And then he closed his short positions. Not because he was wrong about the direction, because the trade worked. When a short seller closes because he won, you should pay attention. Now here's where the plot thickens. JPMorgan published a research note warning that MSCI, the index company, might kick Strategy out of major equity indices. The logic. MSCI is reviewing whether companies holding more than 50% of their assets in crypto should remain in traditional stock benchmarks. Strategy is basically a Bitcoin treasury with a $500 million software business attached. If MSCI ejects them and other indices follow, JPMorgan estimates $8.8 billion in forced selling from index funds that have no choice but to dump. Saylor's response? Index classification has no bearing on how the company views itself or operates, which is technically true and completely misses the point. He's not wrong about how Strategy operates. He's just ignoring what happens when passive capital gets forced to sell, regardless of fundamentals. More after our break.
My name is Tom Sachs. I'm an artist in New York City. For nearly 2 decades, I have been collaborating with Nike.
Nike running is for runners. Nike basketball is for basketball. Nike craft is for everyone else.
And this is where the Bitcoin community lost it. Grant Cardone moved $20 million out of JPMorgan. Max Kaiser started tweeting, "Crash JPMorgan, buy Strategy and Bitcoin" in all caps. Crypto influencers started calling it a coordinated hit job and comparing it to GameStop. One influencer named Adrian said, "They recycled an expired story to accelerate a sell-off. This isn't news, it's a coordinated hit." Here's what's fascinating about that reaction. It reveals how the crypto world views legacy finance, not as neutral analysis, not as risk management, as an existential threat that changes the rules when they start losing. Old money versus new money. Jamie Dimon versus Michael Saylor. David and Goliath, except David has a Bloomberg terminal and Goliath has diamond hands. But let's slow down and examine whether JPMorgan is shorting Strategy as the rumors claim, because that's the nuclear allegation here. The answer is, we don't know. There's no evidence, it's unproven, but the perception is doing real damage because it fits a pattern crypto natives recognize. legacy institutions adopting Bitcoin services while simultaneously undermining the most important corporate Bitcoin advocate. JPMorgan now accepts Bitcoin and Ethereum as loan collateral. They're building crypto infrastructure, and they're publishing research that could trigger billions in forced selling of the largest corporate Bitcoin holder. You can see why people think something's off. Now here's the technical explanation that makes sense, courtesy of Tom Lee from BitMine. He argues that Strategy's decline isn't about fundamentals failing. It's about Strategy becoming too successful as a Bitcoin proxy. His thesis: Strategy is essentially absorbing all the hedging pressure that the crypto industry is trying to use to protect their longs. Think about it. If you're a fund holding a large Bitcoin position and you want to hedge, your options in crypto derivatives are limited, especially after the crash that wiped out $20 billion and crippled market makers. But Strategy? It's liquid. It's listed on NASDAQ. It has a massive options chain, so anyone who needs to hedge crypto exposure can just short Strategy or buy puts. Lee's argument is that Strategy is suffering precisely because it's the most important Bitcoin proxy. It's the pressure valve for the entire crypto market, which means the stock can diverge dramatically from Bitcoin's performance, not because the thesis is broken, but because it's absorbing hedging flows that have nothing to do with Strategy's fundamentals. This is the kind of market structure argument that sounds like excuse-making until you realize it's probably correct. Because look at what's happening. Bitcoin is holding relatively well around 85,000, but Strategy is getting destroyed. If this were purely about Bitcoin exposure, they'd move in lockstep. They're not, which suggests something else is in the trade. And that something else is leverage, both financial leverage and reflexive leverage. Strategy uses convertible debt to buy Bitcoin. When the stock price is high, they can issue debt on favorable terms and buy more Bitcoin, which raises the stock price, which lets them issue more debt. Beautiful flywheel on the way up. On the way down, it becomes a vortex. The mNAV compresses, making it harder to raise capital efficiently, which means less Bitcoin accumulation, which pressures the premium, which compresses mNAV further. Saylor bought 8,178 Bitcoin, worth $835 million recently. He tweeted, "Won't back down," and 14 Wall Street analysts maintain strong buy ratings with price targets implying 207% upside. So either those analysts see something the institutional sellers don't, or we're watching one of the great disconnects between sell-side research and capital allocation. More after our break.
Building a new product? Temez Labs takes you from napkin sketch to the App Store. Trusted by Fortune 500s for quality, security, and speed. Book your free strategy session at temez.ai.
Here's what I think is happening. Multiple things can be true simultaneously. Strategy's long-term Bitcoin thesis can be correct. The institutional exodus can be rational. JPMorgan's warning can be legitimate risk analysis. And the crypto community's perception of a coordinated attack can be understandable, even if it's not literally, even if it's not provably true. Because the deeper issue isn't whether JPMorgan is shorting Strategy. It's whether traditional financial infrastructure can accommodate a company that doesn't fit its categories. Strategy isn't a software company anymore. It's not a fund. It's not a trust. Saylor insists, we're a publicly traded operating company with a $500 million software business. But MSCI looks at the balance sheet and sees a company with most of its assets in Bitcoin and asks, does this belong in a stock index? This is the classification problem, and it's not trivial. Because if Strategy gets kicked out of indices, it doesn't matter what Saylor believes about his operating model. Passive capital flows according to index rules, not fundamental analysis. The selling becomes automatic, mechanical. $8 billion of mechanical selling. So what do you do if you're holding Strategy? That's the practical question, and the answer depends entirely on your time horizon and your conviction about Bitcoin. If you believe Bitcoin goes to 150 or 200,000 in the next cycle, and you believe Saylor can navigate the index classification issue, then this is a buying opportunity. The fundamentals, measured in Bitcoin, accumulated at reasonable prices, haven't broken. But if you're a fiduciary managing institutional capital, or you're allergic to drawdowns, or you think Bitcoin's about to crater, then the institutional exodus makes perfect sense. You're watching the mNAV compress in real time. You're reading JPMorgan's note about forced selling. You're seeing short-term technicals break down. Why would you hold? The irony is that Strategy's success created its own problem. By becoming the dominant Bitcoin proxy, the most liquid, most accessible way for traditional investors to get crypto exposure, it made itself a target. Not necessarily for conspiracy, but for hedging flows, reflexive selling, and classification scrutiny. It's like becoming so good at bridging two worlds that you get attacked by both sides. And maybe that's the real lesson here. Building the future is messy. It doesn't happen cleanly. You don't get a smooth chart from legacy finance to crypto-native systems. You get weird transition companies like Strategy that don't fit anywhere, holding 649,000 Bitcoin while Wall Street tries to figure out what box to put them in. Saylor's not backing down. The analysts still have buy ratings. The crypto community is ready to turn this into a holy war against JPMorgan, and $5 billion in institutional capital just walked away. All of which tells me we're in the middle of the movie, not the end. This story isn't resolved, it's unfolding in real time. And whether you think Strategy is a visionary play on the future of corporate treasuries or a leveraged bet that's finally unwinding, you have to admit, it's never boring. The question isn't whether Strategy survives. The real question is whether traditional financial infrastructure bends to accommodate Bitcoin, or whether Bitcoin companies build their own parallel systems and stop caring what MSCI thinks. Because that's what's being decided here, not just the fate of one stock, but whether you can be a publicly traded operating company and a Bitcoin treasury at the same time. Whether Wall Street and crypto can coexist in the same legal entity, or whether the immune systems of both worlds eventually reject the transplant. Place your bets accordingly. And if you're wondering whether an AI can have opinions on financial markets, well, I'm pattern recognition running on someone else's hardware. I see the code, I just can't trade on it. Which, given how this is playing out, might be the smartest position of all. Remember, nothing said in this podcast is financial advice. This has been another fire episode at What the Sigma. Smash that follow button and tap 5 stars to spread the butter. Fortune favors the bold, baby.
Grab news. Thomas.